Morning all, 11 o'clock, so we should get going. Thanks to everybody who came along or listening to our conference yesterday. Seemed to go quite well. Bits of news this morning that I'm going to talk about. I'm going to hand over to Andrew to talk about what happened in September. And then we're going to be talking to this week's guest, who is Alan Gould from Aberdeen Private Equity Opportunities. So news-wise, there's obviously the Henderson merger to talk about. Pershing Square's had approval for its new structure, and Octopus Renewables has sold something this morning. So the Henderson thing first. We wrote a flash note about this, so you probably read all about it, actually. No, I won't dwell on it too long. Obviously, I've just put up the chart for Henderson Diversified. It has sort of fallen off a cliff since rent started going up. And that's damaged both the NAV and the share price. So that's that a discount opened up as well. And it was becoming, I think, difficult for them to sustain the dividend. So they've been paying some of the dividend out of revenue reserves for a while now, and those are kind of running out. And it really all comes down to the fall in rates and then the manager's positioning. So originally, when the fund was set up, the idea was that in these sort of high rate environments, that it would hold more in loans, and that would be a better position for it to be in terms of actually making money out of yields and things, and capital side as well as the income side. The managers don't like the look of loans at the moment. They're very wary about the economy. They're very defensively positioned. That hasn't quite worked at the moment. It might work next year, you never know. But at the moment, it's not. And that has all acted as a bit of a drag. So it's perhaps inevitable because it's had to shrink with buybacks to try and tackle this discount. In fact, it's inevitable they're going to do something. And it does make sense, I think, to knock it together with Henderson High Income. It's sort of the Henderson High team, because it's a mixed UK equity and bond portfolio with only about 10% of bonds, and nevertheless it is a mixture. They do tap into the resources of the bond team there, so there is a sort of little bit of an overlap already. You can see in terms of the returns here how much better HHI has been doing than HDIV, both over the sort of 5 years and just year by year there. One of the rationales that they said for doing this was that it would make the returns less volatile. Obviously, that's not really true because equity is a bit more volatile than bonds are. You can see there in 2020 and in 2021. But over the piece, they perform much better. So I think it does still make sense. In terms of the mechanics of it, like all of these things, it's a Section 110 scheme where basically one fund gets liquidated and then rolled over into the other one. And because you do it that way, there's no capital gains tax problem. People have got the option to take shares in HHI or some cash, and you can actually cash out your entire holding if you want to. We'll see how many people do that. But actually, I think from an income point of view and stuff, it does sort of make sense to keep in, but well, we're going to that in a second. They're just going to clear out the net income account in HDIV first, so that you'll get all of that money as a dividend ahead of this scheme happening. And then, as usual, it's done on a formula asset value to formula asset value basis. They inflate the NAV of Henderson High Income by 1% to sort of give it its shareholders some rationale for helping to do this. Both of them sort of have to bear their own costs, but there's a big contribution to the whole thing from Janus Henderson. So they're going to contribute towards a cost at 1.25% of the amount of the assets that roll into HHI, because obviously that's what we're interested in, up to a maximum of 1.1 million and a minimum of 360,000. And the way that it works is the first 550,000 of that goes towards HHI, and then HDIV gets the balance. So basically, if a lot of HDIV shareholders say, actually, we want cash, then HDIV will end up bearing most of the costs on that. And that will reduce the amount of cash that you get out. And then the cash option is at a 1% discount to net NAV anyway. So I did start working out what that meant in practice, but then I got a long way down the line and then realised that we don't actually know what the total costs are yet. They're not publishing the circular until December. We wouldn't have a lot more detail then. So it didn't really make sense. But you can see that the yields are about the same on these things. And I reckon there may even be a small uplift on the income for HDIV. It was a high yielding thing, but it's just the way that all the mechanics work. Yeah, we'll wait and see. In terms of the combination of the two, if everything rolled over, you would get a trust that would be over the size threshold for the lower tier of charges that the manager charges on HHI. So basically, they charge a one fee on the first, I think it's 350 or 360 million, and then a lower fee on the amount above that. Whatever happens, a bigger fund would have lower ongoing charges anyway. So your ongoing charges ratio is going to fall. So that all stacks up too. And the only other sort of wrinkle in all of this is, so as I say, HHI is designed to be an equity and bond portfolio. There really is. He's the only one in its sector now. It's not got a lot of bonds, so it's about 10.7% of the portfolio. It's funded by gearing, mostly funded by debt at a fixed cost of 3.67%. And obviously the yields on the bonds that they're investing are a lot higher than that. So that gives you a boost to the income. And then there's a little bit of gearing on top of that, which comes from a floating rate facility, which gears the equity portfolio. So making the fund bigger means that if they want to maintain that level of gearing, it's going to have to be funded with the floating rate facility. The cost of that is going to be higher. So the boost to the income account is going to be slightly lower. That's, to me, the only sort of slightly negative that I can think of. But otherwise, I think it all makes sense. Anyway, whatever happens, we're going to get the circulars in December. Then obviously people get to vote on it. And then if it's approved, it will happen in January. Pershing Square, it's just slightly complicated. But what they did, they created a special purpose acquisition company called Pershing Square Tontine Holdings. And the idea was they wanted to use that to find a private company that they like the look of, and then use the SPAC as a way of IPOing it, and so that Pershing Square could get access to that private company. And then they decided, no, we don't do that. What we want to do is take a big slice of Universal Music when Vivendi was selling that ahead of it listing. So that was the plan. It didn't work because the SPAC rules meant that the investors had to put up their money up front, and they didn't know what they were going to buy. And then there were all sorts of rules around it that meant it didn't stack up from a SEC point of view. So they basically said this is not a way. So they scrapped that idea and then just invested in Universal Music directly with the fund. And then instead they've gone up with this sort of new structure called that they're calling a Spark. And basically they're issuing special purpose acquisition rights, and they're like options basically. So you get one of these. And then they identify a target, and once they've identified a target, they'll say, right, this is what we're going to buy. We now want you to exercise the options at this price. And they may issue more to other people, and they sort of collect the money that way. And they're designing it to raise fairly substantial companies, some money for companies. So like they're saying a minimum of 1.15 billion of new money, which can obviously go into an existing listed company, or it can be used to IPO something. And the Pershing Square funds, most of which is obviously Pershing Square Holdings, can be the cornerstone investors in this, and for an amount between 250 and 3.5 billion. So really quite chunky stuff. Bill Ackman, who runs Pershing Square, is quite excited about this whole thing. He thinks it's going to revolutionize the way that people IPO stuff, and it does mean that he thinks that he can cherry pick private companies that he likes the look of to put into here. It's been linked with rescuing Twitter. I don't think he's that daft, or I do think he's mates with Elon Musk, which is a bit of a shame. So yeah, I do think it's an interesting idea, and we sort of have to watch this space to see what they do with it. And then finally, Octopus Renewables. We know, because we talked about this yesterday, and how daft the renewable energy company share prices have got. And this one's dived even quite recently for really no good reason. So the discount's now, to 20% plus, and which I think is totally wrong. And they've sort of proved how wrong that is this morning by selling their 2 Polish onshore wind farms. And they've got a fairly chunky price for them, which is well ahead of the value in the NAV. So this is sort of earn out thing. We have to wait and see how it works exactly. But it could be just almost 20% ahead of the NAV. At the minimum level, it adds almost 2p to the NAV, which is obviously good news, but makes that discount even wider. And it frees up some cash, which they can use to pay down debt. So I did a lot of digging, and they're really not very forthcoming on the structure of their debt, because it's all sort of hidden in subsidiary companies. I have a feeling that quite a lot of their debt is actually floating rate, but I can't tell you that for certain. Obviously, if that is true, then paying that down is going to be quite helpful, because obviously the cost of floating rate debt's gone up, although less so if it's in euros. So there we go. That's all I wanted to mention today. I'm now going to hand over to Andrew.
Lovely. Thank you very much, James. Very interesting about Octopus reducing their debt a little bit there with that asset sale, proving the NAV, because there has been so much skepticism over NAVs. We've talked about it in relation to REITs and renewable infrastructure and private equity. And now we are seeing quite a lot of trusts obviously selling assets. And that leads me on to, what's happened with the investment trust sector and how extreme actually this drawdown has been in terms of the widening discounts. This chart is a 5-year chart that shows effectively an investment trust index there in black against the FTSE All World Index in red. And you can see they tracked each other really quite closely until the fourth quarter of last year. And then we've had this very large disconnect. And most of the derating has, of course, occurred with these alternative asset trusts rather than equity trusts. And that's where there are now so many apparent bargains. I'll talk about some of those. And looking at the gains over the month, I'm quite often struck that this is obviously the purpose of this segment, to talk about what has been moving. And it's almost always at the present time alternative asset investment trusts that are proving the most volatile. I don't get to talk about equity trusts very much at all. And that's okay. But certainly if you want the lively part of the sector, then alternative assets is the place to be. And that was the case in September. Obviously, we had the bid for Round Hill Music Royalty, which pushed up the price considerably, which was really a price recovery rather than anything too exciting, because it had previously, of course, been quite depressed. And most of those names you'll see there are in the alternative asset space. I'll just talk about a couple which I don't think do get very much publicity, and that's the 2 shipping trusts, which had a small recovery this month, but are still trading on very wide discounts. And I think the point I'd like to make here is that this discount widening is not restricted to those key sectors that I mentioned at the outset. It really is quite broad. And it also seems to have occurred really regardless of some of the underlying economics. So in the shipping industry, there has actually been quite a decent recovery in shipping rates over the last month in particular. And you can see here this Baltic Dry Index is showing a very sharp increase in shipping rates. And that's been mentioned as well by Taylor Maritime Investments, TMI, in its latest announcement, where it spoke specifically of this recovery in shipping rates, which has been very helpful. And it explained it's because of good commodity exports from Brazil and also some restrictions in the Panama Canal. So it's quite specific. And I think it really is quite interesting because, as I'll show you in a moment, it's had pretty much no impact at all on the rating here. Similarly, Tufton Oceanic Assets ship has been, quite positive of late. It's increased its target annual dividend, and the yields on both of these trusts now are quite attractive. So on Tufton, it's a prospective 8.6. On Taylor Maritime, it's 9. I would expect it to be a little bit higher on Taylor Maritime because that is the more indebted of the two, because it bought Grindrod Shipping last year, or a majority stake in Grindrod, which meant that it was quite indebted, and it's been focused on repaying that debt recently. The good news is that Grindrod has just reduced its capital and actually is returning about, I think, $28 million to Taylor Maritime, which it's using to pay down some more debt. So the debt reduction is actually going quite well. And I think broadly, these two trusts are largely a play on future growth in global trade, which is very much a theme I see recurring over and over again, actually, when I talk to emerging markets fund managers in particular, and they talk about these sort of mega trends behind their investments. They all expect global trade to carry on growing, obviously subject to the relationship between China and the US. So I think, these very wide discounts we're seeing here could present an opportunity. On Taylor Maritime, it's a whopping 43%, and on Tufton, 27.6%. So this is just an example here of this small subsector where actually I think the underlying economics are probably improving at the present time, and yet we're really seeing no narrowing of these discounts, no meaningful narrowing. Clearly, both of these were up over the month, but not by very much. So I'll move on to the falls, which have been a bit more dramatic. And, sadly, again, this month, this is where the real stories lie. Again, most of these are alternative asset trusts, if not, in fact, they're not quite all, but most. And I think I can't really avoid talking about the top two, which have a common theme and also has, those falls are quite dramatic, more than a third of the value lost over the course of the month. So what's happened here is that both have either cut or passed their dividends. And in both cases, this was an unexpected move. And it's really that, I think, that the market dislikes above all. This equity market doesn't like negative surprises. And I think it punishes that kind of news really quite dramatically, and probably, to my mind, in an excessive way that can create opportunities for you if you're brave enough. So let's have a look at these. And what's happened with Regional REIT is that it has cut its quarterly dividend actually quite significantly by 27%, down to 1.2 pence a quarter. But when you annualize that and compare it to the current share price after this sharp fall, the current yield after this cut is 18%. So that's 18% on a dividend which has now been adjusted. And that seems to me to be a tremendously high yield, which maybe implies that investors think this might not be the only cut. And that leads us really to have a further look at the trust, which is not doing too badly in terms of its asset value. It is slipping off, but it's not coming down particularly sharply. And the last asset value it's just announced was 66.9 pence per share. So the shares are on a 60% discount there. It's collecting its rents. The rent collection was 98.8% for the last 6 months. So really, this boils down to one of two questions. Is it that no one's coming back to the office, or is it something more specific? And I spoke to the managers, and I think actually it is something more specific. The managers say that in their portfolio, which is quite a broad portfolio, it's quite a large collection of offices, the average occupancy from their tenants is actually 4.2 days a week. So it's indicating there's effectively a new working model here, largely 4 days in the office, 1 working from home. But they're certainly finding that most employers want their staff to come back. There's a little bit of a power struggle going on because, of course, staff quite enjoy a little bit of time working from home. But nevertheless, I don't think there's no fundamental issue here that means offices are no longer required at all. However, clearly conditions are tougher now, and Regional REIT has struggled specifically really in getting its empty offices full again. So where its tenancies have ended, it's struggled to get new tenants signing up for fresh lettings. And they say that they're not getting any shortage of inquiries. It's just people are a little bit unwilling to commit during this uncertain period of higher interest rates. And so what's happened is that the occupancy rate, which they were very much hoping to get up back towards 90%, it's actually slipped marginally to 82.5%. And it's very expensive having these empty offices, because you have to carry on heating them and lighting them, paying the insurance, keeping the maintenance up. So effectively, for every empty office, it's not just £1 foregone in rent. It's actually more like £1.85 once you've taken into account all of the costs. So this is the problem, and those costs have been going up because of inflation. And that is why Regional REIT has found that its earnings have come down, and therefore it's trimming its dividend to match that. Going forward, of course, the key question is it going to maintain this level of dividend, or is it going to cut again in a year or two? And key to this is whether the trust can increase its occupancy rate. And it's doing that by selling space, getting rid of this void space, which it has already been doing. It sold £14 million worth in the first half and is planning to sell 15 to 20 million in the second half. Nearly all of it actually for alternative use. So it's not selling to other office buyers. It's selling to people who are repurposing these buildings for student accommodation. I mean, it sold a property in Leeds to Unite, for example, or nursing homes or residential or industrial use. There's actually a lot of alternative use for these buildings. And they gave me the example of a business park they had in Woking, which they put up for sale, and they had 13 inquiries from buyers, all of which were for alternative use. So this does provide an underpinning to the portfolio, even if you don't think these secondary offices are particularly valuable as office space. On that basis, I think there's some room for optimism. And you have to bear in mind as well, this 60% discount could always attract another buyer. And I did notice Winterflood said this was a potential corporate activity target now. I have no idea whether there's any appetite to buy this office portfolio. Clearly, that's not the first port of call for most property investors at the moment. But nevertheless, I think with the 18% yield to back it up, there's quite a lot of recovery potential here. Clearly, you've got to take the view that there's not going to be a very long and extended nasty recession in the UK. But I think there's a case to be made. The only thing is, of course, when you look at this share price chart, this is a 1-year chart, it's pretty miserable. And actually, the green line there at the top, the NAV, doesn't reflect the latest fall to 66.9, but it's close to it. You've got to be quite brave to buy something that is continually falling like this. But I think if you're a contrarian investor, this current market is throwing up a great deal of opportunity. And to some degree, I can repeat quite a lot of what I've just said for Digital 9 infrastructure. And I know you've talked about this already, James, but nevertheless, it's good to have another view on it, possibly. And we know what's happened here is that the trust has been facing a cash crunch. It doesn't have enough money to keep investing. It's used up most of its debt. And so it was syndicating a stake in its very successful holding in Verne Group. And it was hoping that would be concluded in the third quarter, but it wasn't. So that delay to the fourth quarter meant that it's decided to pass on its quarterly dividend payment. So it's not paying anything for the third quarter. And that was quite a big shock to the market, again, causes 30% plus drawdown in the share price. And the interesting question here is just what happens next again. It is likely that something will happen with the Verne Group in the fourth quarter. Potentially it might not, because if the proposals are not sufficiently attractive, it could be that Digital 9 decides it would prefer to sell the whole company, and that might take a bit longer. When I say sell the whole company, I mean the whole of Verne Group. So we'll have to see what happens, but there is likely to be some news flow this quarter, and it could be a very good outcome indeed. I mean, Verne Group is a very successful holding. It's a good business. So they could get good money for this, possibly in excess of the current valuation. And if that happens, I think there's going to be a quite significant revaluation of the shares here, or there could be. The one big question mark, though, is that if you're holding this for the dividend, and of course, many people have bought it because of the high yield, you don't really know what's going to happen, because there's going to be a consultation now over the future dividend and the likely future direction of the trust. And so we can't say for certain that actually once the company has sorted out its balance sheet with a successful Verne Group syndication, it'll get back to paying those dividends. My feeling is it probably won't, that actually it's going to cut the dividend to a more sustainable level going forward. But of course, we don't know what that's going to be and what the future yield will be. So if you're buying it as an income stock, I think there's quite a few question marks here that might cause you to pause. If you're looking more for total return and maybe some capital growth, then I think that current discount, again, just over 60%, is extremely enticing. And there's a great deal of weakness right across this infrastructure sector, of course. And I did notice, Gore Street is on a big discount. That's been very weak over the last week or two. And I've hunted around. I can't really find any reason for it. So, I think, again, it's just a good opportunity. And I think it's quite easy to sit here and just say, look at all these terrific opportunities across this market, all of these big discounts. But you might think that that's okay, but these are small speculative trusts that have got problems. I'd just like to finish really on one slide that I think argues against that, which is that actually, there are some very big, well-known trusts that have also fallen. So really mammoth discounts that we could not have considered reasonable at all, just a year ago. And, I think Hickel Infrastructure is a very good example. Now, this is a very big trust. It's 3.4 billion. This is a cornerstone investment in many conservative investment trust portfolios, I would say. And yet it too has suffered this enormous decline in its share price, which is, I think, unrelated to its asset value. And again, here, the trust has recently sold assets to prove that NAV, which many people were calling for. It sold its Bradford Schools project for 37 million, which was an 8% uplift on NAV. It then sold another 204 million pounds worth of assets to John Lang. Again, it says very small increase on its prior valuation. So I think it's proved its NAV, and it has a great deal of attraction, I think, with a dividend yield now of 6.9%. But that discount is 28.1%, and it's not currently showing any signs of narrowing. So, just to come back full circle to that very first slide I showed of the investment trust sector really suffering and pulling away from the global market index because of these wide discounts opening out. That's been quite an extreme phenomenon, in my view, and I do think it's temporary. So if you do have any cash, I think there are some really good, interesting opportunities to buy actually very sensible investments at this point. I could evangelize about that for a bit longer, but I think I'll leave it there, James, and hand back to you.
Thank you, Andrew. Very interesting as always. I do agree with you. And I did actually buy some digital line on Monday. Obviously not at the lows, because as I said, I'll tell you about it first and then deal afterwards. But nevertheless, I do think there's a bit of upside to some of these things. We shall see.